Gold just crossed $5,300. Oil is up 20% since January. The Dow shed over 500 points in a single session. And the conflict that triggered all of it, it's still running. Right now. Today. Most people see these numbers and feel one thing: panic. They don't know what's connected to what. They don't know why gold is moving, or what oil has to do with their 401k, or why the stock market dropped before a single explosion happened. This video fixes that. By the end of it, you'll see the entire machine, how the Iran conflict is transmitting through global markets right now, what comes next if it escalates, and exactly what to watch so you're never caught off guard again. But first, the thing almost everyone gets completely backwards. People assume war hurts markets because factories burn or supply chains collapse. That eventually happens. But the immediate damage isn't physical. It's psychological. It's traders pricing in what could happen, not what has happened. And right now, the gap between those two things is enormous. The Strait of Hormuz is a narrow stretch of water between Iran and Oman. 20 million barrels of crude flow through it every single day, roughly 1 in 5 barrels consumed on the entire planet. There are bypass pipelines, but their combined capacity covers about 2.6 million barrels, a fraction of what Hormuz carries. Iranian naval vessels have already been broadcasting warnings to commercial ships in the strait. It hasn't closed, but the threat alone is enough to move global energy markets because traders don't wait for confirmation. They price in the fear before the event happens. That's why oil was already up 20% before the first strike. Not because supply disappeared, because fear arrived first. And that fear is just the beginning of a chain reaction that runs straight through your portfolio. Here's exactly how it transmits, and once you see this sequence, you'll never read a conflict headline the same way again. When crude rises sharply, it's not just gasoline. Airlines pay more for jet fuel. Trucking companies eat higher diesel costs. Manufacturers watch energy inputs climb. Every layer of the global supply chain feels it at once. So investors run the math forward. They see thinner corporate margins. They revise earnings estimates down. Stocks start falling not because profits have dropped, but because investors expect them to. That forward-looking recalculation is what's been moving markets, not bombs, arithmetic. But here's what most people miss entirely: not all stocks are falling equally. And this gap is where the real danger hides for anyone holding a broad index fund right now. Energy producers benefit when oil spikes. Higher crude means higher extraction margins. Defense contractors are moving higher too. Military escalation means bigger government contracts, longer production backlogs, guaranteed revenue streams for years out. But airlines are getting crushed. Cruise lines are getting crushed. Consumer discretionary companies, anything depending on people having disposable income and cheap transportation, they're absorbing the damage. Here's the problem. If you're sitting in a broad index fund, you're holding both the winners and the losers simultaneously. And if you panic sell the entire index, you're dumping the very sectors that are benefiting from the crisis. That's not protecting yourself. That's working against yourself. And this is exactly when the second mechanism kicks in, the one that turns a normal sell-off into something far more dangerous. Stay with me here, because this is where most people check out, and it's the part that matters most. When the VIX, the market's fear gauge, spikes past certain thresholds, institutional investors don't call meetings. Algorithms automatically reduce equity exposure. Pension funds, hedge funds, endowments, their risk management systems sell mechanically, regardless of fundamentals. That forced selling accelerates the decline beyond what the underlying economics justify. More volatility triggers more algorithmic selling. It feeds on itself. The VIX already climbed by a third in 2026, before this conflict escalated, sitting just under 20, with the S&P near all-time highs. That combination, elevated volatility against stretched valuations, is a compressed spring. The conflict is the force releasing it. So the chain runs like this. Oil spikes, earnings expectations drop, algorithms sell, volatility rises, more algorithms trigger, more selling. The cascade accelerates, and then capital doesn't disappear, it moves, fast. And it moves to the same place it has moved during every major crisis since 1973. But before I get there, I need to tell you something about what this kind of market environment does to your brain. Because this is the part that actually determines whether you come out of this ahead or behind. I've watched this psychology play out before. From inside it, 2020 was the one that hit me hardest. March. Everything collapsing simultaneously. I had money in the market, and I remember sitting there watching the numbers move, feeling this overwhelming pull to just get out, go to cash. Wait until things made sense again. I didn't sell. But I came close. And the people I knew who did, they didn't get back in until late 2021. They missed almost the entire recovery. Not because they were stupid, because their brains were doing exactly what brains are wired to do when threat appears. Here's the science behind it. The human brain processes financial loss through the same neural pathways it uses to process physical danger. When markets drop and headlines show missiles, your amygdala fires. Threat response activates. Your prefrontal cortex, the part responsible for rational long-term thinking, goes offline. Behavioral research consistently shows that investors feel the pain of losses roughly twice as intensely as the pleasure of equivalent gains. You are not irrational for feeling this. Your brain evolved to flee from predators, not to calmly assess geopolitical risk premiums in crude oil futures. But here's the thing, recognizing that your wiring is working against you is the first step to overriding it. The investors who come out of this ahead won't be the ones who felt no fear. They'll be the ones who recognize the fear as a biological response, not a financial signal, and acted from strategy instead. Hold that, because it connects directly to everything I'm about to show you. When risk spikes globally, capital leaves equities and corporate bonds and moves into assets with no counterparty risk. Right now, that destination is gold. Gold has surged past $5,300 an ounce, up roughly 11% in February alone, the strongest monthly performance since 2012. Silver jumped nearly 8% in a single session to $94 an ounce. These aren't random moves. They're the safe haven leg of the transmission chain, doing exactly what it always does. But here's what separates informed positioning from blind panic buying. Gold isn't moving on fear alone. It's moving on three forces simultaneously, and understanding all three tells you whether this move has more room to run. Force 1, direct safe haven demand. Capital fleeing risk assets needs somewhere to go. Gold has no counterparty risk. It doesn't need a functioning banking system to retain value. Force 2, inflation expectations. If oil continues climbing toward $100 a barrel, every input cost rises: food, transport, manufacturing. Investors buy gold before that inflation is fully priced in. They're doing it right now. Force 3, the one most coverage ignores: real interest rates. Gold competes with bonds. When inflation rises faster than nominal rates, when real yields fall, gold becomes relatively more attractive. Central banks right now are frozen raise rates and risk crushing a slowing economy, or hold and let inflation run hotter. Gold tends to win in both directions of that dilemma. This is why the gold move isn't done. All three forces are still building simultaneously. Now, here's where most financial coverage completely drops the ball: the US dollar. And this matters directly to how you interpret every asset move you're seeing. In almost every geopolitical crisis, the dollar strengthens. It's the global reserve currency. When the world gets scared, foreign investors buy US treasuries, which means buying dollars. Safe haven demand flows into both gold and the dollar simultaneously. But here's the tension. A stronger dollar typically caps gold's gains in dollar terms because gold is priced in dollars globally. When the dollar rises, gold becomes more expensive for international buyers, which suppresses demand at the margin. So why is gold still surging despite dollar strength? Because the US is now a net energy exporter. Higher oil prices actually benefit the American economy in ways they didn't in 1979. That shifts the dollar dynamic. The dollar strengthens, but not as aggressively as it would if the US were still a major oil importer. For the rest of the world though, Europe, Japan, India, South Korea, the picture is completely different. These economies import the majority of their energy. A sustained oil shock hits their currencies, their inflation, and their growth simultaneously. Their central banks face an even worse version of the dilemma American policymakers face. That divergence, America relatively insulated, everyone else exposed, is why this conflict has the potential to fracture global markets in ways that don't show up cleanly in the S&P 500. The stress is showing up in emerging market currencies, in Asian equity markets, in European energy stocks. And if you're only watching US markets, you're seeing maybe half the picture. Now let me put all of this in historical context, because 1979 is the closest parallel we have, and what happened then needs to be front of mind right now. The Iranian Revolution disrupted about 4.8 million barrels per day, roughly 7% of global production at the time. Oil more than doubled in 12 months. Gold went from around $200 an ounce to over $800. By January 1980, nearly a 400% move in 1 year. US inflation hit 12%. The Fed eventually raised rates to 20% to break the inflationary cycle. A severe recession followed. Here's what makes today potentially more dangerous. The Strait of Hormuz carries 20% of global oil consumption. If Iran escalates toward a full closure, the potential supply shock is nearly 3 times larger than 1979. Backup capacity from Saudi Arabia and the UAE covers maybe 2.6 million barrels, not 20 million. And global exposure has deepened dramatically since then. Nearly half of India's crude imports pass through Hormuz. China buys more than 90% of Iran's oil exports. Europe depends heavily on Gulf energy flows. In 1979, this was a regional crisis with global ripple effects. Today, a full Hormuz disruption is a direct stress test on the entire global financial system simultaneously. The 1979 parallel doesn't predict the outcome, but it shows exactly what the stakes look like if this escalates one more level. And right now, that escalation is still on the table. So, where does this actually go from here? There are 3 realistic paths, and each one requires a completely different response. Path 1: de-escalation. Conflict stays contained. Diplomatic channels reopen. Retaliation remains limited and symbolic. Oil pulls back towards $65 to $70. Stocks recover quickly, possibly within days. Gold gives back some of its premium as the risk narrative fades. This is the pattern from previous limited strikes. Markets overreact, then normalize within a week once retaliation stays muted. Path 2: prolonged tension without full disruption. The conflict drags on for weeks or months, but Hormuz stays open higher. Insurance costs, shipping delays, elevated risk premium, but no blockade. Oil holds between $80 and $90. Markets stay volatile and range-bound. Energy and defense outperform the broader index. Gold stays supported, possibly pushing higher, because the geopolitical risk premium persists indefinitely. Central banks remain frozen between inflation and growth fears. This is the grind scenario. And it's the most dangerous one for retail investors, not because the losses are the biggest, but because there's no clean signal, no dramatic crash, no obvious recovery moment, just persistent uncertainty that slowly erodes confidence and invites the worst decisions over time. Most people can handle a crash. Most people fall apart in the grind. Path 3: major escalation. Hormuz closes. Iranian strikes damage Gulf oil infrastructure. Oil surges well above $100. Inflation spikes globally. Markets correct sharply as margin compression and recession fears compound simultaneously. Airlines, consumer discretionary, emerging market equities take the hardest hits. Gold pushes towards $6,000 as investors seek simultaneous protection from inflation and financial instability. Silver, already in structural supply deficit for the 6th consecutive year from solar panel demand alone, accelerates dramatically. This is the 1979 replay. Except the numbers are bigger, the global exposure is deeper, and the starting point market's already stretched. Volatility already elevated makes the potential moves larger. Here's how you read which path you're actually in without needing to predict the future. Watch 2 numbers every morning while this conflict runs: oil price and the VIX. If oil holds below 80 and VIX stays under 22, markets are pricing scenario 1 or early scenario 2. Rotation is happening, but panic isn't. Energy and defense outperform. The broad index stabilizes gold, holds its gains but doesn't accelerate. If oil pushes consistently above 85 and VIX climbs past 25, you're not in scenario 1 anymore. The cascade is accelerating. The transmission chain is moving faster than most retail investors can consciously track. That's when having already understood the sequence and positioned accordingly is the difference between watching the chaos and being ahead of it. You don't need to predict which path plays out. You need to recognize which one you're in as it unfolds in real time. That's not prediction. That's reading the sequence. Most people will watch this conflict play out the same way they've watched every crisis before it. Feel the fear, react to the headlines, make the move that feels safest in the moment, which is almost always the move that costs them the most in the end. The investors who come out of this in a different position won't be the ones who got lucky with a prediction. They'll be the ones who understood the machine, who knew that oil moves first, stocks rotate, second volatility, cascades third, safe havens absorb, fourth and dollar dynamics shape the whole picture underneath. Who knew which sectors win when energy spikes and which ones get destroyed? Who knew the difference between the grind and the escalation before the market told them? The Iran conflict is still happening. The chain is still running. Every link is still moving. And now you can read it. The question was never what the market does next. The question is whether you're watching the chaos or watching the sequence. Those two things look identical from the outside. They lead to completely different outcomes. Which path do you think we're heading into right now? Drop it in the comments. And if you want me to go deeper on any specific part of this gold technicals, the Fed's impossible position, dollar dynamics, in-depth defense sector breakdown, oil price targets for each scenario, tell me below.